Good day, everyone. Welcome to our webinar for September month. As usual, I'm going to begin in America. I'm just going to put the chart on the screen. It shows the S&P 500. During the month that's just passed, and quite recently, in fact, about a week ago, Jerome Powell, who's the new chairman of the Federal Reserve Bank in America, the Fed, proposed a new approach to monetary policy, which will be more dovish. And in that approach, he's going to look at making employment, full employment, the main factor for the Monetary Policy Committee, rather than controlling inflation. So he's going to go for full employment. And obviously, that's considerably more dovish than the previous approach, and Wall Street was quick to latch onto that and drove the S&P 500 to new record highs. Before the COVID-19 pandemic, the US was at what economists theoretically called full employment, but it was actually at 3.5%. Economists in the past had said that 4% was full employment. Full employment is the point where, because there are no additional people in the workforce, wages start to go up as companies bid for more and more scarce employees, and that has an impact on inflation, obviously. So when you reach full employment, you would expect inflation to start moving up. But full employment was reached at 4%. And now economists are having to adjust their perceptions and their ideas, and they're now saying that full employment is around 3.5%. Obviously, COVID-19 caused unemployment to rise in America quite dramatically, and that is now being reversed. Unemployment is dropping again, and the Fed is basically saying that full employment is now their goal, their number one goal, rather than controlling inflation. So that's more dovish, and the market reacted very strongly, as you can see on the chart here. Obviously, the number of COVID cases is falling now, both in this country and also in America, and that is very positive. But the main thing that's driving markets is the very powerful monetary and fiscal stimulation which the U.S. economy received during the COVID pandemic. Obviously, that is driving Wall Street now. Last night, Wall Street closed at a record high of 3,526, which is well above the previous high of 3,386. And you can see here on the chart, you can see there's the previous high up there, 3,386. I've drawn a straight line across to show that we went through that level a few days ago. In fact, on the 21st of August, we did in fact predict this in the last confidential report that we would break to a new high. What is perhaps surprising about this is the speed with which the market has gone up since then. This jump from 3,386 to 2,526 has been very dramatic and very fast. And here you can see the V bottom quite clearly now. We predicted this back in March over here. We said that the downward trend would turn into a V bottom. We didn't expect it to be like other bear trends. Even though it fell through 20%, the S&P 500 fell by more than 20%. Nonetheless, because it was caused by circumstances which were not due to the economy, but rather due to the virus, we said it will be a V trend, a V bottom, and as the virus is brought under control, the market will recover very sharply, and that's exactly what is happening now. Okay, but of course, what is now more important to understand is that we are back in the greatest bull market that has ever existed, and I just try and put that on the screen here for you. I'm going to suck in a bit more data from the left so that you can see the whole bull trend from its starting point in March of 2009. There you can see the bottom point in March 2009, and the rise in the S&P 500 over that period. If I just take off all these other line studies here, you can see that if we put a trend line on here, starting from that bottom point, and by the way, that bottom point was the 6th of March 2009, and the S&P 500 reached a level of 666. What we see as the upward trend is this here, which is defined by this trend line. And you can see the impact of the coronavirus here. And we call this downward trend here an aberration. It's not a proper technical bear trend because it doesn't come about as a result of anything in the economy. So unlike previous bear trends, it's recovered extremely quickly. In fact, the V bottom completed in 6 months, almost exactly 6 months. Bear trends normally last at least 18 months and sometimes as long as 2 or 3 years. So this is clearly not a normal bear trend. Obviously, the Federal Reserve Bank has responded to this bear trend, this downward trend. It's responded to COVID-19 in exactly the same way as all Reserve Bank governors in America respond to downward trends in the stock market, starting with Alan Greenspan back in 1987 when the market crashed. He recovered that market by getting the G7, the 7 biggest economies in the world, to stimulate their economies through injections of cash. That policy was followed ever since then, from 1987 right up to the present day. And it's been followed by Ben Bernanke, who was Alan Greenspan's successor, and then Janet Yellen, who followed on from Ben Bernanke, and now Jerome Powell is in charge of the Fed. And of course, he's doing exactly the same thing. The U.S. Congress has approved $2 trillion worth of fiscal policy, of stimulation for the economy in America, and the Monetary Policy Committee has dropped interest rates effectively to zero. So the economy, then the stock market, is now responding very, very strongly to that. And the bull trend, which has been in place since March 2009, is now resuming. And in fact, if anything, it's much, much stronger because of all this stimulation. And of course, this situation cannot go on forever. We suggest to you that an economy cannot boom forever, because sooner or later a booming economy does become inflationary. And that means that the Fed will have to step in, and other economies will have to step in and start raising interest rates again and tightening the money supply, which will, of course, lead to a downward trend in markets. But we don't think that's going to happen for some time. We would urge you to go back to our website at www.pdsnet.co.za, and under the heading About, you will find our dissertation on our fundamental approach, our underlying approach to the stock market. And I think you should read that. It's a 6-page document, and it gives the background to how we approach the stock market and the context within which we see this enormous bull trend that's been going on for more than 11 years. And it's all based around the Kondratiev principle of a 54-year cycle. So I suggest you go back and read that, because you cannot really understand what is going on in the markets of the world today without that context. All right, let's turn now to the South African economy. Obviously, President Ramaphosa has been able to reduce our lockdown to level 2 and allowed alcohol and cigarettes to be sold again. And obviously that means that there's a greater return to normality in the economy. This will obviously curb job losses, reduce job losses. However, despite all that, many businesses, small businesses, will fail, and their market share, whatever they were selling, will be quickly taken up by their stronger competitors, which is normal in a capitalist system. The strongest survive, the weakest go to the wall, and that is the way that it has always been. But the economy will recover very, very quickly. Unfortunately, we've back to Schedule 2 load shedding. It's mild so far, but it's obviously a big problem. The government is in the process of a court case with the unions over the 37.5 billion rand contractual raise in pay that the civil servants were supposed to get, and Tito Mboweni stopped that, and they're now in court. We believe that they will lose that court case because obviously the unions have a contract, and unless the courts want to throw out contracts altogether, they will have to find in favor of the unions. That will pose a big problem for the Ministry of Finance, because they're going to have to find that 37.5 billion rand from somewhere. It's interesting that Denel lost their case when they ignored their contract with unions, and they lost their case in the court. So we expect this court case to be lost. Once that is resolved, of course, the next big step will be the 3-year wage negotiations in the government, where the civil service unions will be negotiating for the next 3 years starting from 2021. We don't think that negotiation will end well. In fact, we're expecting strike action as a virtual certainty, and perhaps the long-awaited showdown with the unions, between the unions and the government, will now happen. If the skeptics are right, then the deficit will go much higher than 15.7%, which was included in the supplementary budget by Tito Mboweni, and it will take longer to repay. Many economists also doubt that the government can save 230 billion as is penciled in that supplementary budget. Of course, if they can't put that into effect, it will threaten the IMF loan which we have just taken. We, in fact, believe that quantitative easing of some sort is inevitable, despite the resistance of the governor of the Reserve Bank, Kanyago. Quantitative easing, of course, means basically printing the money to pay the government bills, and it involves a certain amount of what is known as moral hazard, because once you've done it, it's sort of like taking cocaine. You will see it as the solution to all problems. This ANC government has been found to be corrupt, and we do not think that it will have the self-discipline to keep the money supply under control once it starts quantitative easing. And no doubt that is why Kanyago is against it. But we think it's probably inevitable. Of course, the reform process in South Africa is very important. There haven't been any really notable arrests or convictions of senior officials yet. And everybody must hope that President Ramaphosa has made this his top priority. It seems like he won this battle in the NEC that took place last weekend, and the rand has strengthened notably as a result. People are now seeing him as more secure in his position and less vulnerable to the requirements of the NEC. It looks like he has gained control over it, which is obviously a good thing for this economy. And despite the slow progress of the reform and arrests and convictions, the rand and the bond, the long bond, continue to show that investors prefer us to other countries like Brazil and Turkey and so forth. I was interested to see that Fitch, the ratings agency, the international ratings agency, says that GDP will decline by only 6.7% this year, which is obviously much better than the Reserve Bank's estimate of 7.3%. They also say that it will bounce back to 3.9% positive next year. So economists have been predicting about 10%, but we agree with Fitch. We think it will actually be even better than 6.7%, than a decline of 6.7%, should I say. The virus has not been altogether negative. There's been a sharp shift towards digital business. Many people are now working from home, and the best example of that would be the banks, the large commercial banks, who talk about 70% of their staff working from home now. Once the virus is behind us, that pattern is unlikely to be reversed, and it will be better for everybody. It's better, obviously, for the banks because They don't have to pay so much rent, and it's better for employees because they don't have to waste time and petrol getting in and out to work every day. Almost all businesses are now conducting meetings online using programs like Zoom, and there's been a huge spike in online shopping by consumers, and we think those trends are going to be permanent. In other words, what the virus has done is it's booted us into the digital age, and that would have taken a long time without the virus. So it's not altogether negative, and we believe that once the virus is substantially behind us, once the pandemic is over, those benefits will continue to result in increased productivity in this economy and obviously all economies around the world. The number of cases and deaths is falling quite rapidly now. I saw that yesterday in South Africa we had 1,200 cases. In America they had about 32,000 cases, which is well below their peak of 75,000 cases. Our 1,200 cases yesterday is a tiny fraction of the 14,000 cases we had at the end of July. So it looks like the virus peaked probably at the end of July sometime. And we believe that that's because we have achieved considerable herd immunity, especially in the informal settlements or squatter camps as they are known. We believe that the virus spread very quickly in those squatter camps because of their poverty and the fact that they're so crowded in there, and also the lack of personal protective equipment. We believe it was spread by the taxis from one squatter camp to another very quickly, and that the squatter camps, the informal settlements, have basically gone through this virus and come out the other side. Those who were vulnerable, medically vulnerable, died, and the rest of them are really immune now. And that has meant that South Africa has achieved a fairly high herd immunity very quickly. Of course, this is just a theory and could not be proven without extensive testing. But the population in the squatter camps is generally very young. There are very few people over the age of 60 who are the most vulnerable. Also in South Africa, we've had a policy of applying a BCG vaccination at birth for quite a few decades now, for many decades actually. And that has been shown to minimize the effects of COVID-19. If we are right in our assumption that there's quite a high herd immunity, then we could be fairly certain there won't be a second wave of corona in this country. Let us now consider some other aspects of the economy. The second ban on alcohol was a bit of a hammer blow to the liquor industry. AB InBev cancelled its R5 billion investment into South Africa. Heineken, which is the second largest brewer after AB InBev in the world, is reconsidering further investment here. These two companies estimate that the cost of these bans on alcohol, both of them, was about 30% of their turnover in South Africa for this year. Thousands of small bottle stores have been battling to survive, and many, of course, will fail. Vehicle sales have been quite impressive. In April this year, the worst month of the lockdown, they were 50% below last year. In May, they were 32% below last year. In June, 16.3% below last year. And we've just read the August figures, which are even better. There's a fairly rapid recovery, which is echoed in the Purchasing Managers Index, which has been going up very strongly recently. And in fact, yesterday, it was reported to have jumped 57 to 57.3, which shows strong growth. Most notably, new sales orders were up 71.1%. And that shows that exports and local orders are coming in for manufacturers. This all helps the rand, and the rand has helped it as well. The weak rand obviously improves exports because it makes our exports cheaper on world markets. In the agricultural sector, it has been virtually unaffected by COVID-19. It's a smallish sector. It only accounts for about 3% of GDP, but it employs 900,000 people. And this year we're having the second highest maize crop on record, which obviously enables us to export rather than import. We consume about 11 million tons of maize a year, and if the crop is as high as it is this year, which will be around 15 million tons, then we can export 3 or 4 million tons and bring in foreign currency. In a bad season, we would produce maybe 7 or 8 million tons, then we have to import, but that makes a huge difference to our balance of payments. It also affects thousands of subsistence farmers who depend on growing maize, a small field of maize, to feed their families. In a bad year, these people have to rely on government subsidies and also on charities. But in a good year, they've actually got surpluses. So the weather and the maize crop is very, very important to the South African economy. Also, we notice that the citrus industry has done very well this year. In fact, citrus exports to the US are up 9% on last year. That's because citrus is generally regarded as, eating citrus as a way to mitigate the effects of COVID-19. Denel, of course, is our latest company to go into difficulties, our state-owned enterprise to go into difficulties, going the same way as SAA. It used to be a very profitable company before state capture, and it is regarded as strategic by the ANC, but without funding it will most likely go into business rescue. The new CEO, Talib Sadiq, is facing an extremely difficult situation. Most of his qualified engineers have left, many of them for overseas jobs, and Denel has just lost a 4.5 billion rand contract with Egypt to supply certain armaments. So this is another state-owned enterprise which joins SAA and other organizations like the Post Office in dire financial circumstances. Recent statistics show that as many as 80% of South Africans are relying on payday loans. These are loans, short-term loans at high interest rates, which are borrowed before payday and then repaid on payday. The Reserve Bank says that household debt is as high as 74% of disposable income at this stage. That is a big improvement over the last 10 years. Nonetheless, interest still represents about 9.4% of people's average person's income, the interest he has to pay on debt. The average South African has about 20,000 rand owing on credit cards, about 35,000 rand on personal loans, a bond of on average of 515,000 rand, and motor car finance of about 180,000. As many as 80% of parents in this COVID crisis are not paying their school fees. Some have gone over to homeschooling, of course, and others just can't afford it. The high level of debt has made it very difficult for people to survive this lockdown. Some of the private schools have failed and closed permanently. And of course, in South Africa, there is generally a culture of non-payment. It's a very deep, entrenched idea in this country that things that you use don't have to be paid for. You can see it especially with Eskom. The municipalities are owed 191 billion rand in rates. And of course, the government agencies, various government agencies, owe 15 billion of that, which is quite amazing, really. The Treasury report on this says that much of this debt is not collectible now because it's basically prescribed. I mean, rates are paid on property. Property is a fixed asset and should be collectible. Rates should be collectible because you can always foreclose on the person's property if you cannot collect the rates. So this huge debt can really only be ascribed to bad debtor management, in our opinion. Let us now look at the rand. I'm going to go to the rand chart here quickly. Right, there's the rand chart. It's quite an interesting chart, really. We have always said that the rand is undervalued against first world currencies, and we continue with that position. This was especially true during the COVID-19 period. And it's very vulnerable to shifts in international sentiment, shifts from risk on to risk off and back to risk on again, which typically plague international investors. During a period of risk on, those international investors will withdraw their funds from South Africa, from emerging markets generally, and put them into what are regarded as safe assets like US Treasury bills and also to some extent in gold. When they move back to, that's during risk off. On risk on, they take their money out of those assets which have very, very low returns, and they bring their money back to South Africa because we are offering 9.3% on our long bond against an inflation rate of 3%. So they're getting over 6% real return. On US Treasury bills, the interest paid is less than 1%. So against their 1.4% inflation rate, you're actually making a negative return if you invest in US Treasury bills. So there's a lot of pressure on investors to bring their money back into South Africa because of the high returns. But every now and then they move back to risk off and they shift their money back. And as you can see on the chart here, the initial impact of COVID-19 was very much towards risk off. People withdrew their funds from South Africa. We made a classical double top formation technically, and since then the rand has been strengthening over this period of time. We've had brief bursts of risk off. There's a risk off burst there, another one over here, and we're back in risk on again here. You can see what happened over the weekend with this NEC conference. The rand weakened quite sharply and then gained again once people realized that Ramaphosa had actually won that battle and was, if anything, more secure in his position than he had been. Of course, foreigners are generally giving us the benefit of the doubt. They believe that Ramaphosa will continue to control the situation and will continue in power. And that is why they're investing in South Africa, and that is, of course, improving the rand all the time. We consider that this trend in the rand will continue, and that, of course, is not good for rand hedge shares, but it is good for South Africa and for our inflation rate. Right, let's turn our attention to commodities. April and May were obviously terrible months for mining, as they were for most industries in South Africa. June was much, much better. In fact, the exports of minerals in June were the best for the last 12 months. And that's impressive. And that's with only about 75 to 80% of the workforce back at work in the mines. The rand weakness obviously did help here considerably because it makes our minerals and mining production much cheaper on world markets. Gold exports were particularly good, about 60% above any month in the last 12 months. And platinum group metals were about 20% better, 27% better, but on lower volumes. Glencore has made a decision not to reopen its ferrochrome smelter in Lydenburg. This is a big blow to that area because obviously there was good employment in that smelter, but it's due to the high cost of electricity and the unreliability of Eskom's supply of electricity. In fact, many companies in South Africa are switching to building their own solar power plants so that they have reliable supply and obviously at a much cheaper rate. In the long term, this will destroy Eskom's client base and will result in Eskom ceasing to exist. Orient Minerals is a small mining company, a mining exploration company, which operates near Prieska in the Northern Cape. And it's finally managed, after 5 years of effort, it finally managed to get all the permits it needs to start mining. And it's taken them 5 years, and it's been very, very arduous, according to the CEO, Mr. Errol Smart. He says that there are many other potentially viable mining projects which could be brought online if only they could get permits. So one of our big problems in this country is the burden of bureaucracy. The Orient Minerals mine will generate 40 billion rand in export earnings and provide hundreds of jobs in the area. So you can see the positive impact of bringing a mine like that on stream. All right, let's turn our attention to various companies. I'd like to start by looking at Shoprite Checkers. It's an interesting chart that it has. Okay, I've just put 5 years on the screen. You may know that Shoprite Checkers has been competing with Pick n Pay for decades and decades and decades. For most of that time, Raymond Ackerman, who was the CEO of Shoprite Checkers, dominated the marketplace and was able to keep Shoprite under complete control. But once he retired, Whitey Basson became the CEO of Shoprite, was the CEO of Shoprite at that time. In fact, he's been with Shoprite. He was with Shoprite for over 30 years. And that lack of leadership at Pick n Pay enabled Shoprite to gain substantial market share, and it's now about 3 times the size of Pick n Pay. Would you believe that? Whitey Basson sold out his shares in Shoprite over here on the chart, and he sold them for 201 Rand a share. As you can see, the share went on up. It made a peak at 275 Rand about a year later. And since then, it's been trending downwards. So it shows that Whitey Basson is not just an astute manager of retail. He's also very astute at seeing which way the trend is going to go. As you can see here, Shoprite has been in a downward trend since March of 2018, and we advised you to put on a 200-day moving average and to wait for a convincing breakup. Last year, in the year to the 30th of June 2019, Shoprite produced really terrible results, mainly because of their extensive interests in Africa to the north. The new CEO is a guy called Peter Engelbrecht, and he has actually taken a step of closing their shops in Nigeria because he says that environment is simply too corrupt for him to make money in. And so he's closed that, and he's been having a very good, strong effect on Shoprite. And as you can see, the share came up here, broke out quite clearly above the 200-day moving average. Still in the process of doing that, but we think that Shoprite represents value at these levels. Both Shoprite and Pick n Pay at the moment are sitting on a PE of about 15. And we think they look like good, well, we think particularly Shoprite looks like good value at these levels. Right. Next company I want to look at is Argent. Argent is a company that supplies steel and aluminium products. It's perhaps best known for Expander, the security doors that it makes, and also Jetmaster, the fireplaces. But it also makes fences and ladders and all sorts of other aluminium and steel products. It produced an excellent set of results in the year to the 31st of March. Obviously, that predates COVID, with headline earnings per share up 27.8%. It sits on a PE of just 4.4, 4.3 in fact. But it has sufficient volume for private investors, and the share is trending up nicely. It's always been a good dividend payer in the past, so although it's cancelled its dividend for this year, we believe that it will continue to pay good dividends, and it looks like a good investment. It's one of those companies that will benefit from any recovery in the South African economy. All right, now let's look at Anchor Capital. Anchor is a local and offshore financial services company. It has assets under management of 57.4 billion Rand, and at its latest financials, headline earnings per share were up 28%. There's a good volume traded on the share, and it's trading on a PE of 10, which seems to us very cheap. The CEO is a man called Peter Armitage. He's invested heavily in the company himself, which we always think is a good sign, and the chart is trending up. At this level, we think that this share could be the next Coronation, as Coronation was in 2012. After that, it went up for the next 3 years and went up 400%. So we think this is an asset manager with a very strong future. Right, let's look at Lewis. Lewis is obviously a retailer in the furniture and appliances sector. They've got 779 stores. 116 of those stores are outside South Africa. They do about 65.7% of their business on credit, mostly to lower income groups, but they're very, very good at managing their debtors book. Obviously, the COVID-19 virus has impacted on repayments in the short term, but they seem to have the situation very well controlled. They're trading on a price-earnings ratio of 6.8 or 6.7, somewhere around there. And they are trading also at 1/3 of their net asset value. And they have no debt, virtually no debt. So this company is in a very strong position to survive through the COVID-19 period. And it has a huge store base throughout South Africa and a very well-developed system of managing debtors and selling basically cheap furniture on credit. That's what they do. But they're very, very good at it. They're opening 10 new stores this year, and they've refurbished 150 new stores. We think that they will benefit from the improving economy and that the share is very cheap at these levels. Another company that we like very much is Untitled. This is obviously a franchisor of tiles and sanitary ware and flooring. Sorry about that. There's Untitled. You can see that it made a large basing formation over this period here over the last year, basically from March until August now. But now it's starting to trend up very, very nicely. Again, this is a company which has almost no debt. It's controlled by the Ravazottis, the family, the Ravazottis. And they have control over the whole product line. In other words, they manufacture and retail. So they take the product right from the beginning right through. The environment they're working in is very competitive. It's the tiling industry and sanitary ware industry. These are non-essential in terms of COVID-19, but nonetheless, they have been managing to survive very well. They're also planning to add 10 to 15 new stores this year, and they've bought back 240 million rands worth of their own shares. As you can see, the share has been breaking up out of this island formation that's been in place for a while. And then finally, I want to talk about Cashbuild. I know it's another retailer, but we really think you should be looking at retailers now because we think some of them are very, very cheap. Here you can see Cashbuild. I just put a bit more data. You can see the long-term trend line here. If I extend that trend line a little bit further, you can see that there's a very strong upside breakout here. It's the largest retailer of building materials in Southern Africa, and most of its growth comes from opening new stores. It recently acquired Pepkor's building and construction business called The Building Company, and there it acquired 161 stores and 21 franchises. We think that this is a clear technical upward trend that's developing here, and it's broken well above that trend line. So take a look at Cashbuild. Well, folks, that's about all for this month, and I'll talk to you again in October, the beginning of October, the first Wednesday of October. Thank you very much for listening, and I hope you found it valuable.